Hello again and welcome to Retirement Coffee Talk with Charisse Rivers at Zinnia Wealth. My name is Randy Cook. We're here each week as we sit down and talk through some of the issues of retirement, and I'll bet there's some things that you want to get answered. That's why we have this show, and if you want to pursue it a little bit further, it's a great thing to sit down and talk to Charisse and the team at Zinnia Wealth. Here's the number, 833-368-3680. Charisse, how are we doing today?
Doing great. We just had a movie premiere for our clients. We saw Odyssey. It was really good.
Cool.
Really, really fun. Great movie. It was nice to see the other side of the potential story than watching just Troy. So clients raved about it, and they brought a lot of their friends and some of the grandkids. So I don't know, we had over 150 people or so, something like that. I know, it was a big event and some nice giveaways. And I introduced our new intern. We have an intern. It's the first time Zinnia ever had an intern. His name is Oshin. He's such a rock star. He goes to school up north for financial planning. And he said all of his interns he's done, he's really enjoyed the Zinnia intern the best. So, and it feels like we have a new baby in the office. We're all training him. He's got a whole schedule. He's just not sitting at the front desk doing nothing like he said he normally does when he gets these internships. So it's been fun for us. So
I love
who knows?
I love it. Yeah. We have two new additions to our family as well. You remember last week when we were talking about how your life might be hectic, but you might find out that at that point, that's the happiest time of your life is when you were really busy and everything like that. So my wife is retired now. And so we got two new kittens that last weekend. And so now we have 4 cats, and we are just loving the 2 little babies. They're zooming around like crazy, and they've got all this energy, and it's a lot of fun. So we're
you threw me off because you said you had a nursery. Yeah. I'm like, a nursery? Like, why do you have a nursery? You're like, well, we do this for cats. I'm like, oh my gosh, Randy, I never thought you were a cat guy.
I'm a cat guy, yeah. And so everybody looks, when we say we got 2 new cats, everybody looks at Julie and they go, did you do this? And she goes, look at him. He's the one who wanted them. So I'm the cat guy. So I'm adding some fun to my life that way. All right. Well, we're going to hopefully add some fun to your life when it comes to your retirement. And that is why we are here. And, we can't help but look at some of the news out there. And, Charisse, you and I have talked about SpaceX did the IPO and it went shooting through the roof. And we talk about NVIDIA and we talk about Micron and we talk about all these different stocks and we talk about Bitcoin. And there's ways out there, obviously, that people are making a lot of money. And as a person who has never bought a stock in their life, I've just pounded money into a 401k. And I'll bet there's a lot of people out there that are doing the same thing. I've never bought a stock. But they say, God, maybe I should be. Maybe I should be in this. And what I would like to say today is, if you have a 401k, you probably are in there because that's what they're all buying in order to move your 401k forward. So, Charisse, first of all, are people really interested in being involved with all of this? And then next, does it look like it's too much risk? Because if you start to take a look at some of the holdings that people had, this is where the money is, and there's a certain amount of risk with tech. Are you seeing it out there?
So here's the deal. People want all the hype and the excitement about it and the idea that SpaceX is going to boom. You're going to be part of this thing and it's going to be like a Warren Buffett stock, but they don't want to deal with the consequences of those decisions, right? It's like my son, there's consequences to everything we do. He's buying and selling cards right now. And I said, you're going to lose 30% if you sell this card to hopefully get another card. I'm like, that seems like a loss. And I try to explain how my clients don't want a 30% loss. They don't want me to buy and sell for it to not make sense. So as I'm telling this, I'm thinking about my clients. I mean, think about when SpaceX first came out. You could buy it at 135 to 150. It went all the way to $220 or something. Now it's back to 125. I always tell my clients, I always wait when there's a new IPO because it always goes up and then it comes down. And sometimes it doesn't go up for a while. So you got to be patient. But I also told a lot of clients, so these are my DIYers that just love to buy stocks. But I had somebody who came in recently. He's like, Charisse, I really wish I would have bought into SpaceX. He's like, we bought in NVIDIA, and and I was like, yeah, and you don't like the ups and down risk of that in retirement. He's like, I know, but it's for a long hold. I said, well, we have a lot of overlap now. I said, because we have an active managed account that we're trading. It can be day traded, and you can have more NVIDIA, SpaceX, and Tesla in that account. And then you have your buy and hold account. And then you have your quarterly traded account. And then you have this other account. So we have all these accounts. I was like, you are overexposed to some of this technology. I said, if we keep buying in this buy and hold bucket, it's going to be too much. So I'm like, so what are you trying to do? Like, are you trying to get rich? Or are you trying to protect yourself from being poor? And he went, well, I don't want to be poor, Charisse. I'm like, all right. I'm like, if we make 30% this year and you got $1 million, you feel like you're going to be rich? He went, no, but that would be a great return. I said, are you going to go change your spending habits? Are you going to go buy an RV? He went, no, I'm never going to change my spending habits. I'm like, but if you have $1 million and we lose 30%, now what? He's like, oh, I'm going to be poor. my $1 million goes to 700,000. I'm like, yeah. I said, the more tech we add, the more chances we can be poor. And he laughed his butt off. He's like, how do you always have a way to explain things? I said, I do whatever you want. But I'm kind of like, I'm the therapist of money. You're in a different season of life. We're living off this money. And this is not the time to screw it up. You made $1 million. You said you never want to go down. We always want it to go up and you want to live on it. He's like, okay. He's like, we stick to your strategy. Stick to your strategy. They loved their returns last year. They even referred a client to us because the client said, hey, they just said they're living off their money the last 5 years and their accounts are still growing. I'm like, yeah, we're in a great market, right? And we adapt to market changes. And he said, well, I'm a big stock buyer. I'm like, well, then I'm not the right office for you because I'm a big stock buyer. So I want to pick the stock. I don't want you to tell me what stock to buy because, that's my job. That's what I get paid for. He went, oh, well, I appreciate that. He's like, I'm not used to that. He's like, maybe I will like Zinnia. So it's just really talking people off the ledge. And it's not to say, no, we cannot. It's to make sense and do the math. And what are we trying to accomplish? Because what you did for the last 30 years, maybe you were buying the stocks, maybe in your 401k, you had the technology and the S&P, like you were saying, and now you're retiring and you have these 401ks that you're moving to IRAs because that's what you're supposed to do. And now we're getting more diversified. And so I'm helping people. It's psychology of the brain. And it's now teaching the last 40 years how to switch gears to the next 30 to 40 years in retirement and how, okay, you've already ran that gamut. We've already ran the race. Let's play it more conservative. I'll get you what you need at the same time so you can be excited about those run-ups, but let's be really cautious how much of your portfolio actually has that.
I think that what Charisse has hit on there is a really important point, and that is the difference between when you were working for somebody else and getting a paycheck and putting money away is a drastic difference from you not getting that check and you using that money and spending that money in order to live. That is a dynamic change there, and we have to think about what else should change, and maybe our ideas of what we need in our portfolio also has to change. Let's sit down and talk through that. What do you need in your portfolio to do the things you want to do in retirement, to cut down the risk? Let's sit down and talk through it. Charisse will do a complimentary retirement consultation. If you go to the website, which is zinniawealth.com, you're going to see those words right there. There's a gold box. And what that means is it's really a meeting. It's to sit down and talk about your concerns. Maybe a question's just like this. Hey, Charisse, should I be in NVIDIA, SpaceX, Bitcoin, all these different things that you hear about all the time? Let's have that discussion. 833-368-3680. 833-368-3680 for a no-cost, no-obligation appointment with the team at Zinnia Wealth. All right, so one of the other things that you'll see out there is how much cash should we have? And, people talk about having that emergency fund, and we talk about that a lot. We could talk about that some more. But right now, there are $8 to $9 trillion, with a T, trillion dollars in money market accounts in this country, ready to be deployed, I guess. I don't know. But maybe that's just making people feel good. So, Charisse, I want to ask you about the role of cash for retirees. Yes, there's the emergency fund, but should we also have money on the side as well in order to, shall we say, deploy if there's an opportunity or to draw upon if there's a bad market? What do you see there?
Well, I have to first ask the question when I see this much cash, especially in somebody who's coming into our office for the first time. So a lot of time it's for emergencies, and it's that comfort blanket. I got to have this much cash in my portfolio. I just always feel like it's so important. And sometimes it is that comfort blanket. Sometimes it's an emergency fund, but people don't realize what kind of emergency do you think you're going to have that you're going to need $300,000 that can't be invested in something that can't take a loss, but still have access to it? Like, let's think through those things. So it's really just talking people off the ledge. Like, okay, I get it. I like having my emergency fund too. My expenses are $10,000 a month. And for the next 6 months, if something goes wrong, I need to have $60,000 in savings. And if you want to be a little dramatic about it, if you want to go 12 months, okay, put 120,000, but not 300,000. So it depends if I'm talking to the person who's just their entire life, it makes them feel safe and sound that the cash is there, they can grab it and nobody has control of it, then you're losing to inflation most of the time. So if you're worried about losses, that's not a good plan. Then you have the person who overfunded cash for that emergency fund when you only need 6 months, maybe 12 months if you wanted that much in there, because you still have access to other money for emergency. So we forget that sometimes. And then for those people who want opportunity. So once in a blue moon, I'm not sitting here buying and selling stocks because I have managed accounts that are buying and selling the stocks and the funds inside of it. So we don't need to do that individually anymore. So people are getting it. But once in a while, we'll keep some cash on the side for opportunity. Some of our actively managed accounts are doing that. Sometimes markets get a little risky to pull a little to cash, wait for it to go down, and it buys back into technology or the S&P when we start to see positivity. So it is taking action. But the DIYers are very famous for leaving the cash there, waiting for opportunity. They're doing either swing trades or day trades. Swing trades are like every 30 days, sometimes 60 days getting an opportunity, but they miss it so often because they took that one day, they took their eye off of it and it swung up and they missed the opportunity. So you just have to be careful because there are 3 walks of life out there. And my job as a financial advisor, a retirement planner, is to listen to you and hear where you've come from for the last 30 to 40 years. Our advisors are trained to do this as well. And then really sort out, okay, where are we at? What's going to make this person happy? Give them a massive menu of options and let them pick. And then based on our income plan, we make sure that menu matches their income plan. So their income checks don't stop. So it's not cookie cutter here making those decisions. We want to make sure there's absolutely enough cash, because the last thing, especially if you're a DIYer, you're going alone, the market goes down 10% or 20%. And you need income, you don't want to pull money out of that account that just went down. So again, we're talking about getting ready for retirement planning, not buying and selling every day, not waiting for opportunity, because in retirement, we should have an average return over the next 10 years, 4 to 6%. We're going to have those gangbuster 10-year periods where, yeah, those averages are going to be higher, right? But we don't want to have the no-go years where 2000 to 2010, it was a lost decade. And the average, when you added it all together, was 1.8%. Like, we don't want that. I would rather have a safe 4 to 6% and then get lucky on some years and get maybe a little bit higher return, right? Not all accounts are going to make the same kind of rate of return. We can have that high flying account that is a set it and forget it, the NVIDIAs, the SpaceXs, and you have your money, but we want to be careful how much cash we have. We want to make sure we have enough cash in case the market goes down to live on, or have a safe money bucket that if the market goes down, you're not pulling income out of there. You're pulling out of your safe money bucket that maybe is making 4 or 6 or 12%, whatever the strategy is. So you really have to think about it, because here's the deal. Income planning is the most critical. It is the foundation of the next 30 to 40 years in your retirement living. And so if you don't have that safe money bucket, you don't have the income bucket, and you do need a growth bucket. You need all those buckets to make this thing work, right? Income makes the world go round, Randy. And so how do we shore up income so that the checks don't stop? And that is a well-driven, detailed, comprehensive plan.
One of the things you said in the last segment here is that people haven't made the shift, their mind shift. And we talked about the different things that you just mentioned. We went through the tech wreck. We went through the subprime mortgage crisis, the Great Depression. We went through COVID. We went through all these different things. And people probably had a little bit of more of a safety mindset during those periods of time. I need more cash then. Well, we're not there now. Do people have to make a kind of a mental shift within their portfolio management and their idea of risk when we move into these different phases of the economy and the stock market?
Yeah, to have $8 to $9 trillion in our economy in cash, that tells me something else. And I'm seeing it every day when people come into the office. And it sounds horrible, but I'll call it COVID brain. We went into this COVID zone. Interest rates started going up. So we bought all these CDs and we had all these money markets. And so it took people 2 years to really get ready for that. And once they started doing it, then the stock market went up, and now interest rates are down, and now those CDs and money markets aren't making as much money, but we're stuck. It's a psychology in that COVID brain moment, because that's what happened. So you have to have a financial advisor that's saying, hey, okay, we went through that, but now interest rates are down, markets should be going up, or whatever the other investments that are out there that are able to take advantage of these market moves and these interest rate moves, we want to move over to them. But if you don't have an advisor who's doing that all the time and communicating with you a couple times a year about it, you are going to miss some of these run-ups. So we just want to make sure we don't get stuck with our head in the mud because of what we went through, because it's scarring. It's a scar. Like, I mean, think about when somebody breaks up with you. Like, you're like, I'm never going to date again, or I get divorced, I'm never going to get married again. We kind of get stuck on that. But is that true, or did we just need to find the right thing, the right person? It's the same thing with investments. People lost money during COVID. They shielded their money in cash and CDs, and now markets are going up. And back then you're not going to say, hey, I'm never going to go back in the market again, but you're not going back into the market. You're not going to some of these other safe money strategies. You're really getting stuck. So you have the ceiling, you got to break through the ceiling. You got to have somebody speaking it into you, talking to you, showing your plan, saying, hey, here's a possibility. Like, shouldn't we take advantage of it?
This is the advantage, I think, of having a financial advisor. And this is what Charisse does. She's watching the economy, the markets, and she's helping people in retirement. And you get the benefit of all of that, of all the meetings that she has and all the years that she's helped people retire. You're going to retire once. She's retired an awful lot of times. Give Charisse a call. Let's sit down and talk about your concerns. If it is about, how much cash should I have? There is a great question you could start the meeting with. 833-368-3680. Again, 833-368-3680, or online, it's zinniawealth.com, ZINNIA wealth.com. There's a button there. It's gold in color. You'll see that. It says complimentary retirement consultation. That's a no cost, no obligation meeting. Let's sit down and talk through your questions about your retirement. Again, 833-368-3680. Charisse, that is all the time that we have on this one. I will give you the last word.
Well, as usual, live by design and not by default. And we'll see you here next week.
Thanks for listening to the Retirement Coffee Talk podcast. If you have questions or would like to begin the process of building a tailored retirement plan, call Zinnia Wealth at 833-368-3680 or find us online at zinniawealth.com.
Investment advisory services offered through Zinnia Wealth Advisory, LLC, a registered investment advisor. The firm only conducts business in states where it is properly registered or is excluded from registration requirements. Registration is not an endorsement of the firm by securities regulators and does not mean the advisor has achieved a specific level of skill or ability. Insurance products are offered through Zinnia Wealth Management, LLC, Florida license L078655, and Charisse Rivers, Florida license P037744. Zinnia Wealth Advisory, LLC, and Zinnia Wealth Management, LLC are affiliated entities. The information presented is believed to be current. It should not be viewed as personalized investment advice. All expressions of opinion reflect the judgment of the presenter on the date of the podcast and are subject to change. The information presented is not an offer to buy or sell or a solicitation of any offer to buy or sell any of the securities discussed. You should consult with a professional advisor before implementing any of the strategies discussed. Any legal or tax information provided in this podcast is general in nature. Always consult an attorney or tax professional regarding your specific legal or tax situation. Any client experience discussed on this show are unique to that client. Annuity and life insurance guarantees are subject to the claims paying ability of the issuing insurance company. If you withdraw money from or surrender your contract within a certain time after investing, the insurance company may assess a surrender charge. Withdrawals may be subject to tax penalties and income taxes. Persons selling annuities or other insurance products receive compensation for these transactions. These commissions are separate and distinct from fees charged for advisory services. Insurance products also contain additional fees and expenses. Social Security rules and regulations are subject to change at any time. Always consult with your local Social Security office before acting upon any information provided herein. References to specific investments should not be construed as being past specific recommendations. The returns for various indices discussed in this podcast do not represent the performance of the firm or any of its advisory clients. Returns do not reflect the impact that advisory fees will have on an investment. Past performance may not be indicative of future results. All investment strategies have potential for profit or loss. Different types of investments involve higher and lower levels of risk. There is no guarantee that a specific investment strategy will be suitable or profitable for an investor's portfolio. Historical performance returns for investment indexes and or categories usually do not deduct transaction and or custodial charges or advisory fees, which would decrease historical performance results. There are no guarantees that a portfolio will match or outperform a specific benchmark. Investments in fixed income products are subject to liquidity risk, market risk, index rate risk, credit risk, inflation risk, purchasing power risk, and taxation risk. Because bond prices fluctuate continually, their yields change constantly.